and see what the future have for us. And we will touch upon a lot of new dynamics that the geo market is presenting, with the volatility and what can you say, the increasing need to look ahead and hedge price risks in the future. Yeah. So with that, if we start by looking into 2022 and looking at the bulls there, we had a year here which started off with the current year vintage, in 2022, around 1.7 euros per megawatt hour, and it increased until November, where we saw it peaking at around 10 euros per megawatt hour before the bubble kind of burst and it consolidated. But a lot of this happened due to the lower than hydrological balance that we saw in the market or on the power side. And then we have hydropower producers that were cautioned to conserve water in their reservoirs from May onwards as a result of the war in Ukraine and the energy crisis. And this, of course, resulted in supply concerns as the disclosure of suppliers and green power consumers generally is down on a yearly basis. And then you have, on top of that, which I will come back on a bit later, ahead of 22 and during 2022, we had legislative and regulatory incentives that increasingly affected the market. But here you see that both the current year and futures experience this increase, although the closer years, 2023, followed the 2022 curve, while 2024 was traded lower in this backwardation formation that we saw from August and onwards. If we then jump into 2023, where we currently are soon to finish, we saw prices, as I said, they dropped down in the end of 2022 and consolidated there, although with quite high volatility in the beginning of the year. But we saw the market moving again from a backwardation to a contango market around June. And we saw that happening against hydrological balances normalizing, and then in fact exceeding. We have seen a lot of rain, so the hydrological balances here on display in this graph, the Nordics, but we saw similar developments, or we experienced similar levels in the Central Western Europe and the Iberian Peninsula, where you have reservoir levels above normal, and that affects not just the current year, but as you are towards the end of the year here as well. This is the only storage, realistic storage we have in the power sector, which indicates what we have going into 2024 as well. Like you see, when we went into 2022, we were already at low levels, but now we're going into 2024 with higher than normal levels. And so that's the storage aspects of this, right? But if we also look at to the renewable electricity production that we have seen so far, and GeoS is obviously has a correlation to that, although not a perfect 100% correlation, where each produced megawatt hour from renewable electricity results in 1 GeoS, as we have the case of Germany, for instance, where subsidized electricity producers are not getting, are not eligible for GEOs. But according to our end of year supply forecast, we will see the highest GEOs issuance that we've seen so far. And that will amount in, according to our forecast, 777 terawatt hours of GEOs in the under the EECS system, plus minus 44 terawatt hour. But it will be unprecedented high, and obviously, as capacity build out is predicted to increase in future years, this will increase as well. But this we see on the supply side, and then on the demand side, we see that electricity consumption, which also has a correlation with the cancellation of GEOs, is relatively low. According to EMBIS statistics that we got from October, they are actually lower than during the pandemic year. So these two factors has a bearish impact on 2023, as it is already. And we have seen that already in the prices, as we showed in our curve. Then we also have some policy changes, we have seen an increasing interaction from the AIB, for instance. They introduced an export ban on Iceland in the end of May, which was then conditionally lifted in the beginning of June. But now they have just announced that it's permanently lifted. So they have complied with the rectification order that the AIB issued to the Icelandic authorities, and this minimized the risks, I would say, for similar events within the AIB. But we're yet to see what the rectification orders and so forth entail in detail. But maybe an even greater impact we have seen from the GEO Brexit with UK on the GEO side exiting the market, and that entering into full from July this year. And you see the prices has also dropped then. But that has also happened, of course, in the backdrop of the heavy rainfall and high renewable electricity production. But what has happened with the UK is also not a shock to the GEO system, because we have seen a gradually decrease of the demand there, as they already in the start of 2021 required interconnected capacity to be booked for the import of GEOs there. So it has had a relatively smooth phase in the exit of REGOs, but it will affect. So where you had in the compliance period 20 there they saw an import of 41.9 terawatt hour. So if we drawing from those numbers, that's potentially what can fall out in terms of the demand from the UK when from June onwards. So that's obviously a bearish development also for the ex-GEOs or the GEOs in the AIB market. And then, but there are also other things happening with in terms of regulation and policy that are driving the demand, but also driving the supply. I have one graph here looking in kind of like historical prices connected to legislative and regulatory developments, and then this table. I will discuss them both separately, but if you're looking at first the price development, the first thing that strikes most of us is to see the incredible increase. I have just included in this graph vintage 2022, 2023, and 2024 prices. So when not moving within 2022 vintages are forwards, right? So here you can see, really, you can see the value of managing price risks in this market. And you can imagine what profit you could have made if you bought into 2022 vintage in 2021. So you see the increase, well, you see the value of hedging, and that is something that we believe at BAIT that you will see more of in the future, that people will manage the price risks in this volatile market by purchasing on future contracts for future deliveries. So that's one thing that I wanted to show with this graph. But also another thing there is that the price increase did not just come about because of like the fundamentals of the power market and the supply and demand of GOs. We've also seen regulation coming into place. Like first, the internal electricity market brought in the GOs as a mandated instruments to use for disclosure of the renewable energy component. That followed essentially the reform that we saw in the Renewable Energy Directive that said that GOs are the only instrument that you are to use for market renewable contracts as renewables. So PPAs, retail contracts, all these needs to carry GOs if it's supposed to be renewables, and that obviously gives credibility to the GO system and so forth. So it increases the demand for it. It harmonized the approach to GOs in the EU, and hopefully also in the EEA. They are yet to implement the renewable RED II in the EEA agreement, but we hope to see that soon. So Norway and Iceland can pick up pace there. But other things that we've seen is, and there I think also heard from market actors, is that they have seen an increasing influx of industrial users. And that, I believe, comes from the incentives given by state aid schemes. So like in the EU, we have the emissions trading scheme, right? Which brings in power, the power sector there. And that indirectly transfers prices to those that are power intensive industries. And as a measure to avoid carbon leakage of these industries so that they move to other regions, we compensate them, or countries are allowed to compensate them. So now there is, I think it's between 11 or 13 countries in the EEA that have adopted these schemes. But that comes with certain conditions. And one of those conditions is that in order to be eligible for the state aid, the industries affected, such as aluminium and steel, like heavy power consumers, need to engage in energy transition measures. And one of those options is to source carbon-free electricity, equivalent to 30% of their annual consumption. And most countries GOs are the fundamentals of proving this in most countries, except for Norway, and in France they are having a hybrid hybrid approach, which I can talk about. If someone has a question, you can just reach out. But this obviously creates a demand, and that, I believe, has an impact in 2022 as we see it, and it will continue to have an impact. So I have this list here with different laws and policies. And second last, you have the state aid schemes, and that's from 2021, but they will last until 2030. And according to the existing schemes that are in place, they will peak in 2025. And it aligns a lot with how forwards are valued right now. But we must keep in mind that these state aid schemes can also be prolonged, at least until 2030. And from 2030, we don't know how the interaction with the carbon border adjustment mechanism is going to happen. So that's also something that this market is becoming increasingly complex. You need to understand what not just happened in the power market, you need to understand what happens with respect to incentives and carbon markets. So here, like the carbon border adjustment mechanism is supposed to phase out existing carbon leakage mechanisms under the EU ETS. So technically, that will mean that there will be no more state aid. So the incentivized state aid that the incentivized demand we see of GEOs from the state aid schemes will be no more from 2030 if they implement that. There's still a lot to be done on that front. And so market participants will need to have foresight in terms of these developments. But with that fallout, we also have other bullish markets, such as the production of RFNBO. For those who are not familiar with the terminology, it's renewable fuels of non-biological origin, so essentially renewable hydrogen produced from electricity. And that the Commission has come out and said that the GEOs, although not the instrument needed, or like you need a PPA, but you also need to have a GEO with the PPA in order to prove the renewable or the carbon, the renewableness, so to speak, of the electricity used to produce that. So that will also create the demand. And then you have the European Sustainability Reporting Standard that will come in place from 2024. And that's a delegated act. That doesn't mean that countries need to transpose it into their national legislation. It will be there already. And that will affect, what is it, close to, it's 50 to 60,000 companies in the EU. And it essentially states that GEOs is a must for disclosing the energy mix of companies. And also companies need to, when they do the carbon accounting of scope 2 emissions, meaning the consumption of electricity, they also need to use a dual approach there. So they need to use market-based and location-based, which means that they have to consider GEOs because that's the market-based approach in the EU, at least. And so we have these bullish sentiments, but we also have bearish. So we have the renewable electricity targets that the different countries are coming with. So there you have like bearish impacts, and they are now gradually updating their national energy and climate plans. So, but a target is a target. The realization of the target is a completely other aspect of it. So a lot here when analyzing the market and looking into the future, it's not just looking into what kind of targets and laws we have, we also need to look at what is realistic. We need to assess that. And with the prices that we have seen, that puts a lot more, how can I say, pressure on the market to actually acquire the insight necessary for assess present but also future risks. So that we have there. Don't know how we are time-wise. I wanted to go into this. I'm approaching the end here now, but I wanted to also bring in the German case here, as this is not a policy. Well, it is a policy, right? So in Germany, you have renewable production that is subsidized, and they are not eligible for GoOs, but they can also opt out of that system. And we published a report or an analyst update recently where they had forecasted in German how much GoOs that was going to be released to the market in Germany, which you see to the left here. And that's quite a small share of the actual production in Germany, right there. So there you can see how much that is supported. But like with this option of power generators also opting for direct marketing, where they also get GoOs issued, that means that you also need to be aware of how power prices are moving in Germany and GO prices, because these prices combined informs the power producers of when it is valuable to basically opt for direct marketing or not, and that affect the supply and demand. So this will need to have greater, companies engaging in the GO market will need to have greater insight in this. We have at BAIT, we have developed different forecasts based on scenarios in order to see how prices can move also in the long term. So historically, we have looked a lot on real-time trades, and we have a lot of that. We're developing short terms, mid-terms, and also long-term forecasts, as these are very, as Jens initially emphasized, the GO market has become of interest not only to traders short term, but also to people engaging in PPAs and those who want to realize prices in PPAs. So here we have two scenarios. One is building on business as usual demand, bearing in mind this is average prices. So don't look at 2023 in current closing or prices that we are at now. It's volume weighted average prices. So but this is how a higher demand can impact the prices going forward. But all of them are going down, at least in these scenarios that I'm displaying here, because they are projected against quite a optimistic capacity build out scenarios of renewable power generation. So that kind of reflects the EU's net zero emission targets by 2050 and the NECPs. So then you see that prices are going down. But if you start elaborating on the different policies that come in place here, so we are currently also working on like this is a lower, central, and we're working on an uppercase scenario as well, as these scenarios also are valuable for bankability reports and so forth, for people who really want to invest in projects that are there to last for quite some time. But we see prices going down in the future if the capacity build out is going as they are projected and demand follows business as usual, or even if they're picking up a bit. Then if we then take a bit of summarizing what we've been going through here, and and look into the outlook for 2024, which also involves 2023 vintages as they are swapping possibilities there. We see at date that, first of all, that prices have broken the €4 megawatt, €4 per megawatt hour, but it has come up above there, and we see that resistance is kind of dependent on the increasing electricity demand, in particular from businesses and sectors that are subject to regulatory incentives. And that is also going back to this, like it's important to know sector-specific impacts as well in this market, as specific sectors are having increased incentives and thereby demand and willingness to pay for GEOs. At the same time, we have this move from a backwardation to a contango market in June 2023. That provides a bit of a bullish pull. So we have different things that are affecting the prices, and there are a lot of uncertainties in the market. But we expect the 2023 vintage to be traded around 3.5 and 4.5 euros in the coming month. But as I said, the weather conditions can affect developments. When it comes to 2024 vintage, they have fallen under 6 euros per megawatt hour. And we expect them to stay there in short term with a bearish pull from the 2023 price levels due to the 2024 swapping possibilities, and also the energy stored, as I pointed out, in reservoirs, as this reservoir capacity will be able to be used in 2024. The bullish signals for 2024 will be dependent on weather conditions. I think many are kind of waiting and see now, like holding their breath and see how the winter is going to be, if it's going to be mild or quite a cold winter. But also the general health of the economy, inflation rates and so forth. The RE capacity build out affects it, and also the corporate alignment with legislative and regulatory incentives, such as the European Sustainability Reporting Standard. So there's a lot of things affecting the prices, and I think we will see prices being experience some pressure in also beginning of 2024, and then we will see how it develops mid 2024, depending on how weather and uptake in demand and so forth. Then I also think, as I mentioned before, I do think that we will see a move or greater volumes also being traded in futures to hedge price risks in this volatile market. Mm-hmm. And that was it from me.
Daniel, thanks a lot. That was great. Let's dive a little bit into some of the topics. We get already some questions, and I encourage our participants to send us more. We learned that the market is highly dependent and driven by policy changes on the one side. Then we've seen as well, hydro still has a huge effect on the supply side and thereby driving prices. But the demand side seems to be quite complex. So we got a few questions on this. On the one side, there is this kind of business as usual demand. Maybe you can explain that a little bit. This comes, I guess, mostly from industrial clients, or how does demand break down?
Yeah,
how you see that underlying trend, utilities versus industrials? Yeah. Is there something to dive into?
So our business as usual, I think you're referring to the long-term forecast that we're having. So essentially what that is, it's building on existing patterns that we can read from the data. So without taking in consideration policy and so forth. So, and the tricky bit there is that, while power supply and consumption, we get quite frequent and quick updates. But when it comes to the supply of GO and demand, there is a lag there, dependent on how issuing bodies, the AIB, are reporting statistics. And I guess this is also a call out for these institutions to really, like when prices going up like this, it's really valuable to have more frequent updates on how fundamentals are moving. But so our business as usual case, it's taking in consideration. So 2022, we have all the data for, right? But 2023, we don't have the data for. So anything all data. So we can't read out everything that has happened on how legislation is impacting. So with these laws that are coming in place and regulation from 2024, that is not read into that. We can't see how that is affecting the demand. The business as usual case is a business as usual case in correlation with geo issuance and power renewable electricity production and electricity consumption and geo cancellations. But we have, like, in terms of the scenario for the capacity build out, there it is not a business as usual. There we kind of adapt the targets that the different countries with a kind of a sanity check as well. Like we see some countries are jumping, like 29 to 2030 is they're adding all the capacity build out there, which is not really realistic, but we have some sanity check
in the next election periods. But if you look a little bit on the breakdown, where does the demand come from? How much is corporates? How much is utilities, or let's say retail? Do you have a view on that?
I don't have statistic on that specifically. So, like, obviously, utilities are there to disclose for the end users. So the demand that comes from the utilities or the power suppliers are essentially the demand you see in end user sectors. So unless, of course, there is utilities or power supplier that is exclusively market themselves as renewable energy suppliers, but their existence in the market is dependent on end user sector opting for them, right? So in reality, it's the end user sector that drives this, whether or not it's households or it is heavy industries or corporates.
Would have expected that with the plannings for heat pumps and for electric vehicles, we should see a huge increase of green demand on the retail side.
Yeah, so yeah, well, if you look at it in terms of heat pumps are also adding an energy efficiency component to it. So it's not like, if you look at the statistics on which sectors that are going to grow most, like it is the manufacturing sector. Like you have some industries that are experience or will need to experience a lot of electrification. You mentioned transport, that is certainly one, but the manufacturing industry, there you see electricity demand increasing a lot. Like households, it's not that much. And I do think that, like, households are not subject either to the incentives that we see on the industrial side either. But I think what we will see is, at least now until 2030, certain industries will drive the market, and you will see their realization or move to electrifying their industrial processes that will drive the demand. I do think so.
With the increasing demand and absolutely rising prices, usually there comes as well a higher level of scrutiny or a call for more integrity in these markets. I mean, we've seen this quite dramatically on the voluntary carbon side, where everything's collapsing right now because there's simply a huge lack of integrity.
Yeah.
what comes to mind here in GoOs is discussions around what's the future of Norway, or even the hourly certificates which get quite some attention. Do you see a need for these changes or for this debate, and where is it leading?
Yeah, so prices do involve usually more regulation. It's yet to be seen if we will see some kind of commodification in terms of, I mean, like, not that GEOs become a commodity, but that you regulate it as a financial instrument. Right now, it's not included in MiFID, like the allowance under the EU ETS. But I do think that there will be a move to more regulation in this in the field. And sorry, I had forgotten to close one notification here. Can you repeat the question one more time, just briefly? It was about regulation.
I hear just recent weeks as well, the more people pay for it, for this kind of green quality, green electricity, they want to be sure that they pay for the right kind of quality, meaning there's discussions around
the double counting and so forth.
Norway and hydro is a topic very much here in, let's say, continental Europe. And there's a lot of discussion around yearly certificates versus monthly or even hourly certificates. So really the production.
So when you look at these discussions, I see a tendency that a lot of tech providers that facilitate the hourly matching, they are pushing for a lot of hourly matching. And then you see on the other side, those trading in the market, they are really like not, that would actually exclude a lot of people from the market, and that it comes with a trade-off in terms of market efficiency. I do think that hourly matching is far in the future, if at all. Maybe it will come at the point when we don't need the geo system anymore. No, but I think if you look at France, for instance, there they have it on a monthly basis, right? I think that is something we will move towards, and I also think that will be beneficial for the market in terms of insights. But that also brings new kind of requirements of issuing bodies, of those institutions that are there to increase transparency into the market. Like the market will need to have transparency quicker than we have right now. But I do think also, if you look at regulation, we are moving in that direction. So monthly matching, I think we will see sometime in not a too far future.
Yeah. And we need to keep in mind always that kind of a more kind of shorter time stamping leads to less liquidity probably in the market, which makes it difficult to provide prices. I mean, maybe you can evolve a little bit around that, but it's already quite hard to, I mean, you've shown hydro prices from the Nordics, or you have solar across Europe, but we know that there's very specific regional patterns in there around technologies, etc. But it's hard to get the right transparency on these kind of attributes and differences, no?
No, it is. So the geo market is very interesting in the sense that it is not a homogeneous market. It is a heterogeneous market with theoretically a huge amount of different prices. But we do see that prices has moved closer to each other. But we also see a increasing interest in higher granularity in terms of prices. Now we have, like, 2024 is coming up here now, and the RE100 new policy is coming in place, where they have this new policy where the electricity or the renewable electricity needs to come from installations or production facilities that are no more than 15 years old. So obviously this creates sub-markets, like these policies are pushing into sub-markets for these specific attributes. So then there is this challenge, and that is a challenge for also you in NMAC to provide, like your clients with this kind of granularity where they can choose these kind of products that are very tailored to the different off-takers' specific needs and policies. And I do think that we will see. Now we have seen prices converging in a way. Like we could see greater premiums before, but they have been converging. I think that they might move away a bit, so we might see some new markets as well. Like I mentioned the state aid scheme before. In Germany, you have a state aid scheme that and requirements where GOs needs to be sourced, at least 80% of them, from Germany, Austria, or Luxembourg. And those policies they kind of push for premiums in specific regions. So there is a need for this, but there is a challenge because the liquidity is not that great for specific products.
Yeah, exactly. As a trading platform, I'm as well here conflicted. I'm on the one side, we want to see more standardization, which allows as well more churn in trading and more maybe speculative activity if the liquidity is higher. That's the one side. On the other side, if the qualities are not specific and there's not kind of premium differentials in the prices, we may have kind of a race to the bottom. Again, looking a little bit to the voluntary carbon market. At the end, people sell the cheapest stuff, which still fits into a certain bucket. So I think it's a very interesting perspective where we are right in the market and why we have, already hundreds of RFQs around GOs on the platform every month. It's hard to see clearly the patterns. What is the premium someone is willing to pay for, let's say, solar from Bavaria or from Germany versus hydro. But that is clearly, I want to feed that in here. We have a partnership with you, Wade, as well to create there more transparency. And that is, I think, something we should work on in the next years to come. To find this balance between liquidity and attracting more trading interest and more
Ich konnte diesen Titel nicht in deiner Apple Music Mediathek finden.
Sorry, my Apple box here.
Tut mir leid, das kann ich nicht tun.
So on the one side, it's attracting more liquidity. On the other side, it's really making these differentials as well visible and attract specific demand. But you can say that as well. Today, the market in its infrastructure transparency still is very much in its infancy, and it has to improve for what we expect it to deliver in the next years.
Yeah. No, definitely. And it needs transparency, as I said, not only in terms of prices, but also fundamentals. Like there's a lot of transparency issues with the geo market.
Yeah. Is there any discussion around what is the right price for GOs? We had this again on the carbon side where people felt it must be 100 euros. Otherwise, it's not worth reducing emissions. Is there something where you say as well, this would be a good balance between production and investment side versus consumption? What are consumers willing to pay for the green attribute? Is there something like a long-term balance?
Well, this is I would say that the right price is what the consumer is willing to pay for it, and the seller is willing to sell it for. But and there you have like it's also like, what's the purpose of it? If you look at the situation now, like ahead of 2050, we need to double or triple the electricity consumption in Europe, and a lot of that, well, it's got to be renewables. Some of pushing for nuclear as well, right? But it needs to be carbon free.
Yep.
That's the case, right? If we want to avoid dangerous climate change. And then there's this, like, what is going to push that? Is it CFDs of the state, like state subsidies, or is it the market that's going to do that? And so it's a bit like, what role would the GO play for this in the future? So the right price is basically what's our purpose with this? What do we want it for?
So there's no political answer yet, but we're waiting.
I don't think there's. I don't know if well, we'll see. We'll see. But the right price is what you want to get out of it, in a way. Like, if it's gonna move the energy transition, which the prices, as I pointed to in terms of in the German case there, where you saw the power price and the GO price, when they are at a specific level, it's more attractive to move into the market than using the government subsidy. So, but also, like, we need to electrify a lot. So that's no good answer to your question there. I didn't give a specific level, but it is a big.
We need to come to an end already, but allow me maybe one question as well. I mean, in this kind of bullish market with increasing prices, you made clearly the case for hedging and even profiting from these increases in prices. Now you have this more bearish market. Still, you see a strong move to kind of forward prices or future deliveries. Is that a stronger trend you see to continuing, or is this with declining prices coming to an halt?
I think there's a lot of uncertainties in the market. Like, you have the different, because you're trading, like a GO is valid for 12 months, right? And the disclosure period is 12 months. You have this yearly variation in terms of supply and demand. You need to manage those risks, first of all. But then there is also policy risks associated, regulatory risks, and you can translate the risks into opportunities. So I do think, like, even with prices going down, like, I think you will see people engaging more with the market when the prices are low, in order to get also good prices ahead, because we see they are moving. There are a relationship between them, but you also saw in the price curves that I'm showing that they are moving from backwardation to contango, and that is because of the yearly specifics of years. Like, generally, in a year that's been dry, you see a backwardation market, and then if it's more beneficial weather conditions and so forth, you see contango. But I think you will see more price management in the future, and that can be buying in futures, but it could also be engaging PPAs and bundled GOs. Yeah,
now we see that clearly as well in the activity on the platform. There's lots of forward contracts happening right now. That's love to see
prices
that. Parallel to managing power, let's say procurement managing as well in a similar way, the GOs just make sense. So we will have an eye on that, how this develops. Thanks a lot, Daniel. It was really interesting. Interesting market. So I'm sure it will not be the last time that we have discussed it. Thanks everyone for the participants. I couldn't answer all, or we couldn't answer all the questions now, but thanks for participating. We'll share the document or the presentation afterwards. So there was quite some demand for that. And even after the webinar session, feel free to send us a mail or get in contact with us if you have further questions or interest. Just let us know. Thank you for today, Daniel.
Thank you.
It was a pleasure.
It was a pleasure. Bye-bye.